Well, asset allocations are failing retail investors just like you and I. In 2022, during the correction that happened from January to October, the S&P 500 was down just about 22%, but the average retail investor was down something like 37% during that time. Now that makes no sense, because we're told that asset allocation should be used as a measure to tell us how much risk we're taking on in our portfolio, and then also as a way to guide us to diversify our holdings so that we don't participate in all of the losses at a same proportional amount as the stock market. In 2022, it would have made a lot more sense that, let's just say, hold an entirely 100% portfolio in VTI or an S&P 500 index fund, because you would have lost just as much as the S&P 500 rather than losing almost 1.75 times. So in this video, we're going to be talking about how asset allocations are misleading investors just like you and I. We're going to go through this in 3-part video series. In this video, first, we're going to set the framework, why asset allocations are failing, what problems that causes, and explain the metrics we use at Peak Financial Planning to help guide better retirement investing decisions. In the second video, which will come out next week, we're going to talk about and define those 4 metrics that we use internally to help guide better investment decisions. And we're going to show that through the lens of a couple hypothetical clients. And then in the third video, we're going to go through some actual model portfolios using a tool called Portfolio Visualizer and show the hypothetical scenarios using the tool to quantify how would these portfolios have done and how successfully do the portfolios meet the criteria of our metrics. So the thing with the asset allocation here is, and if you haven't watched, I made another video a couple months ago called Asset Allocations Are a Scam, and I talked about this subject in more detail. But at the basic level, some bonds function like stocks and some stocks function like bonds. So using an asset allocation that is a binary between what percent of your holdings should be in stocks and what percent should be in bonds is actually very misleading, because some bonds function like stocks and some function like bonds. Some stocks function like bonds. You could have a 50-50 portfolio but hold a bunch of bonds that function like stocks. Now your portfolio is exposed to a lot more volatility and downside risk. And this leads to the 3 core problems that I believe this asset allocation causes. The first is that it causes impulsive decision making. So in 2022, if you were watching your retirement portfolio go down 20% or maybe even 30%, as in the case with most average investors, you might have started just pulling the trigger on changing the investment mix because you're panicking. You're saying, hey, this measure that told me I would lose less if I had my investment split in this way is no longer working. I don't really know exactly what's going on with the cause. I know I have to change my investments. So it leads to impulsive decision-making in the form of changing the investments we hold. The second problem it leads to is hesitance. So now you change your investment mix, but now you don't trust asset allocation quite as much. You also don't trust the conventional wisdom. So you don't really know or trust the guidance on when you should, quote unquote, re-enter the market. So maybe you sold a bunch of the risk side of your portfolio at the bottom or near the bottom or halfway to the bottom in 2022. And now you're saying, I don't really trust anybody, or I'm not sure who to trust to get back into the risk side of my portfolio. And now you're hesitant. And so you lose more on the front end during the losses. When the market declines 22%, the retail investor loses 37%. And now you lag the market on the way back up. And now if the market, let's say, had a year where, like in 2023, it recovers and has a 24% year, you're now recovering at a much slower pace because you didn't reallocate, or you had changed the investment mix. Now, that's the second problem. The third problem is what I call the confidence loss snowball effect. So you have the impulsive decision-making, and then you have the hesitance, and meanwhile, your portfolio continues to underperform. And now you lose confidence, and that loss of confidence snowballs and snowballs and snowballs. And it either leads to sitting on the sidelines entirely, or continued what I call like spray and pray decision-making, where we're constantly making impulsive decisions that are not based on a foundation of education. So how do we solve this? As I said, we're going to go in more detail into this in the second video, which will come out next week. But we're going to solve this in two ways. The first is we want to think about how to reduce portfolio volatility. If we reduce portfolio volatility, meaning how wide the swings are in the value of our portfolio, we're going to reduce how much impulsive decision-making we have. The second thing we want to do is, after we reduce portfolio volatility, we want to increase our investment-related education. We need to understand more detailed metrics that tell us about the risk levels and the health of our retirement portfolio. Asset allocation is not enough. And that's clearly evident because asset allocation has been the prevailing wisdom from an investment or retirement investing standpoint, and it has not served investors to the expectation that was held for it. So we reduce portfolio volatility and we improve education. So in addition to reducing portfolio volatility, we focus on these key metrics. The key metrics we use to measure expected portfolio volatility and risk in the portfolio are standard deviation, beta, stock market correlation, and maximum drawdown. Now, those 4 key metrics give us a lot better measure of the health of the portfolio. We can back test them and get historical data, and they'll give us a better measure of the volatility so we know and have clear expectations, then therefore can align our behaviors with those expectations. So I hope you like this video. Stay tuned for next week's video. We're going to go into all 4 of those. I'm going to teach the concepts, show them in real time, explain how you can use them. These are not concepts that the average investor would be unable to use. They're relatively straightforward to understand. So next week's video, we'll go over those 4 metrics. In the meantime, I hope you enjoyed this video. Please like the video, subscribe to the channel so you'll get that notification for next week's video and then part 3 eventually. If you have questions or comments, please leave them in the comment section below this video. And as always, if you'd like to schedule some time or learn more about our business, you can visit our website at www.thepeakfp.com, where you can get all sorts of helpful guides like a sample financial plan, a 3-bucket retirement strategy, and so much more. And you can also schedule a free consultation with our fee-only fiduciary financial planning team there as well. Thank you for your time and attention. See you in the next video.